Greetings, comrades. Credit terms refers to the conditions that apply for payment of a credit transaction. And it'll usually look something like this. So if we look at this visual here, as it has the descriptors underneath, for this transaction here, we've got 30 days. 30 days is our deadline to actually settle the account for a credit sale or purchase, depending on whether we're buying or selling. Now, there's a discount on the table here. If we pay within this second number, 10 days, then we qualify for a 2% discount. So that would mean we only need to pay 90% of the amount owing. The rest is a discount that the customer receives. So this can either be an expense or revenue, depending on if we're providing a discount for our accounts receivable or if we're receiving a discount from accounts payable. So we need to be a bit careful with that. In this case, we're going to cover an example of a discount offered to a accounts receivable. So I'm going to acknowledge my source here, as we always do. I've pulled this question from the Macmillan textbook 2025 version, chapter 6. Okay, so the first thing we need to do is we need to have a look at the stem of the question, and what it establishes here is the credit terms on offered 5% if the customer pays within 30 days. So we need to be mindful about dates here. There's going to be some maths involved. So let's go to this first transaction. On the first, we've sold goods to our account receivable, Debney, for 600 plus the GST. So we're just going to debit our asset account. So accounts receivable is an asset because we have a right to collect the economic benefit from the credit sale from June the 1st. So let's just record that in our ledger. June 1. Our cross-reference will be sales / GST clearing. And that's increasing our assets. So that's a $660 debit because we need to factor in the GST, 10%. Then we had a repeat of that on the 8th. We've got a $880 sale. This time it says including the GST. So therefore, that's another debit to our account receivable for $880 sale / GST. Then we get to the 12th. And if we look on the 12th, we've settled the account from invoice 43. So invoice 43 goes back to that sale that we had on the 1st. So therefore, there's an 11-day gap between the 1st and the 11th. So therefore, we very easily satisfy that 30-day terms. So we qualify for the discount. Now, when we enter this into our GL, our general ledger, we can either do a combined entry, bank / discount. I'm going to separate the two just to highlight the maths involved here. So first I'm going to put on the 12th. So this is reducing the amount that the account receivable owes us. So that asset is being decreased and these funds are going to go into the bank account, which I'll deal with a bit later. Okay. Now, we're also going to have a discount expense and the reason why this is an expense is because it actually reduces an asset, our accounts receivable balance, and consequently reduces our owner's equity via the reduction in our net profit. So it satisfies the criteria for an expense based on that decrease in assets and decrease in OE. So to actually work out the dollar amounts of this, I'm going to do a bit of Excel magic. So our discount is, as it says at the stem of the question, that we're going to get 5%. So we need to work out 5% of that 660 sale. The GST is factored into the discount. And so therefore, what we're going to do is type in equals. We're going to click the 660, and then we're going to multiply it, Shift 8 by 0.05. and that's our discount, $33. The bank amount is the rest of that $660. So again, you can either use your calculator, your brain. I'm going to use Excel. So I'm going to go equals, click the amount owing, and then we're going to minus the discount. Okay, so if we total these two up, it should equal that 660. 5% is the discount. The other 95% is the amount we're actually going to receive. And again, you might go, well, why would you offer a discount? Well, we've got those funds within 11 days. Net terms are 60, so it's good for our liquidity if we get these funds more rapidly. Okay, then on the 18th, I'm back to the question here. We've sold goods for $1,000 plus GST on the 18th. So let's debit our account receivable account. Sales / GST. This will be for $1,100. And then we get to the 22nd. We've got another one. June the 20th, another sale. Sales / GST, 1,200 plus the GST, so that's 1,320. And then we get to the 30th, and this time we are settling account number 48. So that goes back to this one here, the second sale. Again, let's look at our dates, 8th to the 30th. That's a 22-day stretch. So we are meeting our credit terms of being under 30. So again, we qualify for a discount. So same as we did on the 12th in terms of our entries, so 30th of June, we're going to have bank, and I'm going to create a discount. Again, you can combine these entries or you can separate, either will be accurate as long as your numbers are correct. So just like I did last time, I'm going to use Excel to help me with the maths of this. So equals, I'm going to click that 880. I'm going to multiply that by 0.05, 5%. Then to work out how much we're actually going to receive, go equals, click the 880, and I'm going to subtract the discount. Okay. So that's it for the entries. Let's just do a couple of entries in these other accounts. In our discount expense, just to highlight the cross-referencing, we have an entry on the 12th, and our cross-reference is not bank. This has nothing to do with the bank. We need to acknowledge that this has come reducing our accounts receivable balance from Debney. Okay, for 33, and then again on the 30th of June we're going to have the same entry, accounts receivable for 44. So again, the reason why this is an expense is because it's actually reducing the balance that our credit customer Debney owes us, so therefore it's decreasing an asset and it's decreasing owner's equity. In terms of the effect on the bank, again, what we're going to do is we're going to debit our bank because our bank balance is going up. And again, we're going to cross-reference this with the accounts receivable. So I'm just going to copy these two down. And this time I'm going to put in the banked amounts. So we've got 627, the bank balance has been topped up by that amount on the 12th, and then we received 836 on the 30th.